China's rise over the last few decades, from a seemingly irrelevant country to the world's second-largest economy, has been remarkable. In fact, statistics from China reveal that over 600 million people have towered above the poverty line in just a few decades. But the unfortunate thing is, China is known for its tendency to falsify figures relating to the country's growth. Recently, news around the world has had the worst about the Chinese economy. But China is yet to verify the claims. So at this point, where does China truly stand? Let's find out. According to China's National Bureau of Statistics, the annual GDP growth of the country fell to 3%, much below the 5.5% official target set in 2022, raising fears across nations because China's economic slowdown has the potential to generate ripple effects across the world. The concerns and challenges facing China and invariably the global economy were well described by Liu He, the vice premier of the People's Republic of China, while speaking at the World Economic Forum at Davos 2023. He said, "Over the past 5 years, we have experienced all kinds of unexpected events and witnessed profound changes in the world's political and economic landscape. Therefore, the theme of this year's annual meeting, Cooperation in a Fragmented World, cannot be more relevant." He continued by saying that the COVID-19 pandemic punctured China's growth, and that China's GDP growth was also slightly lower than forecasts published by the International Monetary Fund in October 2022. IMF predictions expected a GDP growth rate of around 4.4% USD, 18 trillion in 2021, mainly due to a sharp rise of the dollar against RMB. This is the slowest growth of the Chinese economy since the 2.3% registered in GDP in 1974, he concluded. The international community has not held back from talks about China's economy crumbling beyond recognition, an exaggerated view if you ask me. Now, evidence has come to light that the country just might be finding it hard to keep its miracle of sustained high growth rates anywhere close to the usual 10% or more recorded since its economic reforms in the 1970s. Kim Byung-yeon, author and a professor of economics and head of the Institute for Future Strategy at Seoul National University, succinctly argued that the Chinese economy is slipping into the middle-income country trap. According to Kim, productivity that determines the long-term growth rate has sunken sharply in China. This downward trend has deepened since 2014. Over the past 15 years, China's fast growth stemmed almost entirely from the infrastructure investment to build factories, housing, and roads, and less from structural reform and innovation. This has no doubt proven that extensive growth led by capital and labor input is not sustainable. China did experience a sharp and unexpected decline in its GDP growth in 2022. This was blamed on a host of factors, but largely on the country shutting itself from the outside world for too long a time due to the zero-COVID policy. The slow pace was blamed mainly on the strictly zero-COVID policy, leading to periodic lockdowns and the ruling Communist Party's crackdown on big industrial firms, besides the lingering real estate crisis. What is probably the most disturbing fact that has been revealed is that China, the so-called manufacturing hub of the world, recorded a very weak growth in industrial output, precisely 3.6% in 2022, and an even weaker 1.3% in the month of December. Economics and statisticians noted a rebound in COVID outbreaks and dull demand in November that affected industrial production and placed increasing pressure on Chinese businesses. According to them, the factors that weighed on slow industrial growth included a squeeze in profits both from antivirus curbs in big manufacturing hubs such as Guangzhou and Zhengzhou, and from the persistent weight of a protracted property crisis and slowing exports. It was also revealed that in 2022, profits of major industries in the country fell drastically. This crisis affected 41 industries in China, with the ferrous metals, smelting, and pressing industry experiencing the worst decline, precisely at 92.7% from January to October 2022 and 94.5% cumulatively in the entire 2022. Another reason for the recent Chinese industrial crisis is that many Chinese companies are currently facing sanctions from the Western world, especially from the U.S., majorly against the Chinese tech companies which allegedly breach data security and steal patents. FBI Director Christopher Wray said at the World Economic Forum that he was deeply concerned about the Chinese government's artificial intelligence program, asserting that it was not constrained by the rule of law. No doubt China is currently facing some significant economic challenges. The contraction in real estate remains a major headwind, and there is still some uncertainty around the evolution of the COVID-19 virus. Longer-term headwinds to growth include a shrinking population and slowing productivity growth. Obviously, China's high growth based on investment, low-cost manufacturing, and exports has largely reached its limits and has led to economic, social, and environmental imbalances. Reducing these imbalances requires shifts in the structure of the economy, from manufacturing to high-value services, from investment to consumption, and from high to low carbon intensity. Over the past few years, growth has moderated in the face of structural constraints, including declining labor force growth, diminishing returns to investment, and slowing productivity growth. The challenge going forward is to find new drivers of growth while addressing the social and environmental legacies of China's previous development path. Notably, the economy needs comprehensive macroeconomic policies and structural reforms to secure the recovery and promote balanced, green, and inclusive growth. The main question is, can China handle these pressures? While this is good news for some, it is bad news for others. China's economy won't collapse. You want to know why? Here's the simple reason. The International Monetary Fund said so. Shocked? Well, considering the country's massive cash reserves and large investors, the country's economy is not expected to collapse anytime soon, at least not in the next few years. Also, China's economy is set to rebound this year as mobility and activity pick up after the lifting of pandemic restrictions, providing a boost to the global economy. The economy will expand 5.2% this year, according to the latest projections, against the 3% experienced last year. That's good news for China and the world, as the Chinese economy is now expected to contribute a third of global growth this year. Besides that, the external world really shouldn't hope for a fall in an economy like China because of the ripple effect it can have on the global economy. China makes up a sizable part of global GDP, and it trades with many other countries, which means that a Chinese crash isn't likely to be contained with China. Nevertheless, with unemployment at 20%, a housing market crash, strained international relations, a banking crisis, and an outflow of FDI, this is probably still the toughest period that Beijing has had to deal with since the 1970s. Since China's economic crisis became apparent, studies on how its economic turbulence could impact global economies have been carried out. Contrary to popular belief, it was discovered that should China's economy collapse, the U.S. will reap a fair share of woes. While the United States and China haven't always seen eye to eye on diplomatic issues, particularly human rights and cybersecurity, the two countries have built a strong economic relationship with significant trade, foreign direct investment, and debt financing. After Mexico and Canada, China is the third largest export market for U.S. goods, accounting for $123 billion in U.S. exports. As for imports, the U.S. imported $466 billion in Chinese goods in 2014, primarily consisting of machinery, furniture, toys, and footwear. As a result, the United States is China's largest export market. Alongside an extensive amount of foreign trade, China has been a popular destination for U.S. foreign direct investments. The stock of foreign investment from the U.S. into China exceeded $60 billion in 2013, primarily in the manufacturing sector. That being said, the U.S. has a significant trade deficit with China due to U.S. Treasury bonds. Currently, China is one of the largest holders of U.S. debt, amounting to $1.2 trillion. For China, treasuries are a safe and stable way to maintain an export-led economy and creditworthiness in the global economy. As long as China continues to hold a massive amount of forex reserves and U.S. debt, some market observers believe the U.S. economy could be essentially at the mercy of China. Should the Chinese economy collapse, there would be significant ramifications for foreign trade, financial markets, and economic growth in the U.S. and around the world. If anything, the world should hope for the best concerning China to avoid a global economic crisis. That's it. Thanks for watching. While you're trying to like this video and subscribe to this channel, don't forget to drop your comments also. See you.